Morning, everybody, and welcome to the latest edition of the Hayes Family Advisors Client Update Calls. This morning, we have with us Brian Livett from Invesco, and he's going to talk to us about a roadmap to recovery. Now, obviously, we've seen some good motion in the markets recently, but everybody has concerns about what's next. All of our clients are positioned for the long term. If you have money in the markets, it's because they're part of your overall plan. But obviously, people are concerned. So we wanted to spend some time this morning with Brian and get his perspectives. Brian's a global market strategist at Invesco. He's responsible for the development and communication of the firm's investment outlook and insights. He's also the co-host of Invesco's Greater Possibilities podcast. He joined Invesco back in 2019 when the firm combined with Oppenheimer. He started at Oppenheimer in fixed income product management in 2000 and then transitioned to the macro investment strategy group in 2005. He has been quoted in a lot of publications that you would know, such as Wall Street Journal, Financial Times, and appeared on CNBC, Bloomberg, and Yahoo Finance. He earned a BA undergrad in economics from the University of Michigan and an MBA with honors in finance and international business from Fordham University. So good morning, Brian. Welcome.
Good morning, Stephanie. Thanks for including me in this conversation. So, you say people are concerned. I think that's still generally not a bad thing. Usually news cycles emerge out of some pessimism, and certainly we still have a decent amount of pessimism or at least skepticism. So I'm here to offer a realistic outlook for the next 6 months and beyond, but I'm going to be concluding with a good amount of optimism as we think about the next couple of years. And so what have we been dealing with? I always like to kind of empathize first. I mean, this is just a very unique, bizarre environment. This is not the rest of our lives. I mean, it's very rare to have a global pandemic when you shut down large segments of the economy, leading to the government putting a lot of money in people's pockets before the world is ready for it, and you get inflation. And then by the second half of last year, you get this idea that the Fed's going to raise interest rates a lot, which they have. And when interest rates go up, the economy tends to slow. So the market did a pretty good job of pricing in a growth scare or fears of a recession last year. And this year, things have been more resilient from an economic perspective, and the market's certainly reflecting that. Now, can we sustain what we've been doing? Maybe not. This economy is still going to slow. So the reason why we say roadmap to recovery, you've been recovering in markets here. Maybe you roll over a little bit as the economy slows, but ultimately that's what sets the stage for the new cycle, the new elongated market and business cycle. So I don't think that there's a reason to be overly defensive here or overly concerned. I think the market bottom was in the middle of October of last year. Now, what was last year about? Just to kind of differentiate from this year. Last year, it was an everything bear market. Nothing did well. It was one of those rare years where everything got worse relative to expectations. Inflation was worse. The amount of policy tightening we were going to need was worse. Russia going into Ukraine was worse. And all that inflation led to policy uncertainty, which always brings about volatility. Higher inflation means higher interest rates. And when interest rates adjust, valuations adjust. And so if you look at it on a rolling 9-month period, a 60-40 portfolio, 60 equity, 40 treasury, the rolling 9-month that we had by the middle of October of last year was bad, all right, a 60-40, almost as bad as the 2008 financial crisis. And we've been grinding higher. The last 9 months have actually been quite good. So, for investors who are worried, what's the next shoe to drop? How bad is it going to get? Let's remind ourselves that it got bad. It got really bad, almost as bad as it was during the global financial crisis. Markets look ahead. So the market has already considered what the bad economic environment will look like. And it did that from January of last year through the middle of October, which is why I use rolling 9-month periods. And in essence, what you had was a pretty significant valuation adjustment on equities. The way to read this is the equity valuations are up and down on the y-axis. So what are we willing to pay for earnings per share of equities? Across the x-axis is interest rates. And as interest rates go up, you tend to pay less for corporate earnings. And so in the beginning of 2021 or the end of 2020, when in the top left of this, when interest rates were very low, investors were willing to pay more for equities. You didn't really have another option. You can't accept 1%. So I'm going to go pay up. And as interest rates adjust to this 3.5%, 4% range, valuations have come down. So that's healthy. Valuations aren't necessarily historically cheap, but we've had a pretty significant move given the climb that we've had in rates. So that's explained largely what has happened with equities. Where do we go from here? I know there's all this talk about recession. So I want to start with, as I typically do, where are we in this cycle? How much longer is this cycle going to play out? Meaning cycle, the periods of time between recessions. If you look on the right, I have my little end of cycle checklist where you see how cycles play out. Typically leverage rises, meaning companies take on too much debt, the banks lend too much money to people who are, or businesses who aren't going to pay it back. That's not the case this time. Companies are in good shape. The banks are generally in good shape. That's not the case. But what we do have is high inflation, which has caused the Fed to raise interest rates to control that inflation. And cycles do tend to end when the Federal Reserve tightens or has to tighten too much. That leads to economic growth slowing, and that leads to the banks tightening lending standards. And I check 3 of them. So you would look at that and say, yeah, there's a reasonable chance that this cycle will end sooner or later, that we will have a recession. Now, the good news is the economy is too strong right now to think about a recession in the second half of the year. But nonetheless, it takes time for higher interest rates to have an impact on the economy, and that impact is still coming. If you look at all of the tightening cycles, so this is the amount of interest rate hikes you get over the cycles over how many months. 2022 into 2023 is the most amount of tightening we've gotten in the shortest amount of time. So it would be silly to think we could get through all of these interest rate hikes without at least some type of mild economic downturn. Now, given the lack of leverage, the lack of borrowing in the system, it seems quite likely to me that if or when we have the recession, it is likely to be more mild than the recessions of recent memory, like 2020 with COVID or 2008. Investors should remember that there's times where you have recessions like a 1991 or 1981 where they're more mild in nature. So what does it mean for an investor if you look at each of the past 10 recessions and say, okay, how far did we come down? How far did the market come down? How long until we got back to our prior peak? You'll see in the top left, there's a lot of mild recessions where you're down 20, 30% and you recover in a year or two. Now, if you look at the gray box, that's largely what we did last year. We went down 25.4%, very much in line with the more mild recessions. In fact, the average is 31.8. So we did about 80% of the average, but the average also includes more extreme recessions like 08, 01, 73 that are on the bottom right. Now, is this 08? Doesn't feel like it. Banks are in good shape. Is it 01? That was really exacerbated by the terror attack. 73 was a high inflation story, but the Fed had lost all credibility. That doesn't seem to be the case today. So it feels to me like we've already priced in this mild recession and are already working towards getting back to that prior high, which tends to happen over 1 or 2 years. I'm going to use 1981 as an example. 1991 is a good one. In 81, again, you're down, 27, 28%, and you recovered within 2 years. So what was interesting about 80, 81, in 80, inflation peaked in March. Okay, let's see if this sounds familiar. Fed continued to raise rates. The peak Fed funds wasn't until the end of the year. Stocks fell 27%. Everyone assumed you'd get a recession. You did. The markets were volatile during that recession. You turned down some, but ultimately you did okay during the recession. And if you invested when inflation peaked in March 1980, you were quite happy by 82, 83, 84. All right, so markets tend to do well in the aftermath of inflation peaking, irrespective of whether or not you have a recession. Now, today, or in this period, inflation peaked a year ago. The Fed continues to raise rates. The market's already down 25%. Will we have a recession? TBD. How will the market do? Look, don't get me wrong. If we have a recession, I think the market will roll over a bit, give up a little bit of these recent gains. But much like in 80-81, I would expect the market to do well from at the inflation peak. And by the way, inflation peaked in June of last year. We're up 17% in the S&P 500 since inflation peaked. That's how these things normally work. Markets tend to do better. Markets tend to do well as things are getting better, and that includes inflation. Inflation is certainly getting better, and the markets have responded. Now, what is the market telling us? We've been bouncing through this contraction recovery field of markets. We've been in contraction, which is checked off. Contraction means bonds do pretty well. Only narrow parts of the market do well. Larger cap, mega cap stocks do well. That's largely where we've been, which is forecasting a market that forecasting an economy which is going to slow from here. Actually, I'm going to show you a picture that's giving us some sense that the market is actually thinking the economy is going to do okay over the next 6 months. Here's the picture. I know it's a little busy, but the dark blue line is basically whether conditions for lending and our conditions in the market are easing. The light blue line is whether the manufacturing in the economy is improving. It's survey data. And since it's so busy, I'll ask you just to look from 2020. We get COVID, that light blue line, which is a proxy for the economy, plunges. But in actuality, the dark blue starts to turn ahead of it as the Fed eases conditions. So you get that recovery before the economy turns. Ultimately, the economy follows. And then you start to see the financial conditions tighten, roll over before the economy does. The Fed starts to raise rates. And so we've seen financial conditions plunge, meaning most of us feel a little bit less wealthy. The economy following along with it, or at least leading indicators of the economy. We're starting to see now financial conditions turn a bit, the dark blue, getting more positive. And that's because as inflation comes down, the expectation is the Fed doesn't have to tighten forever. And so when you've seen this in 01 or 08, it's not always a straight line up. You can get some jaggedness in it, but it tends to be that when this starts to turn, when the market starts to think the Fed is done tightening, that tends to preview a turn in the economy. So we've been in this contraction feel. We're starting to get more of this recovery feel. I think we'll have fits and starts. I think when there's a recession concern, it may roll over a little bit. But again, if you're focusing on the next few years, when this thing starts to turn, it forecasts better economic conditions in the future. What's driving that is the fact that inflation expectations have come down so much. Here are inflation expectations in the bond market, 1, 3, 5, and 10 years. The dark blue shows you how bad it got last year. And when you're looking at a 6.3 inflation expectation over the next year, that's pretty bearish for stocks, because that means the Fed has to raise rates a lot and valuations have to adjust. When you're looking at where the light blues are now, where we were at the end of May and we're in a similar spot at the end of June, that's the market telling you we're not worried about inflation for 1 year, for 3 year, for 5 year, for 10 year, around 2.5%, which is exactly what the Fed wants to see. So that's when financial conditions can start to ease because the Fed realizes they haven't lost credibility. The bond market believes them that they're going to squash inflation. And what else is helping that? When you think about inflation, first, what tends to drive it is a big increase in the money supply. That's on the left slide. The dash blue is the money supply growth. Well, that's now coming down. So yes, the consumer price index, the inflation metric, followed it up. It's now following it right back down. The middle is an inventory to sales look. The dark blue is sales. The light blue is inventory. The gap is explains why you didn't have inflation for a long time until COVID hit. Then those lines got really close together. Businesses slashed inventory at the wrong time. Now the dark blue is rolling over, so sales are slowing right when businesses are working to rebuild inventory. So you're getting the goods inflation story is over. A lot of people are talking about the service inflation story, but a lot of that's being driven by shelter, and even shelter prices are coming down. Here's just looking at apartment rents on the right. So the inflation story, in my view, is becoming passé. And that's what allows the Fed to back off. And that's how sustained recoveries emerge. And if you look at this chart here, if you look at the one on the left is showing you past periods when inflation goes up. Those dark blue dots are the peaks. Yes, you do get recessions when inflation goes up like that. Those are the shaded areas. But you also find that inflation tends to come down just as rapidly, and in most instances below average. This time looks to be no different. Now, more importantly, if you look at the chart on the right, it's showing you how the market has historically done in periods 1, 2, and 3 years after a peak in inflation. Most of them, they did quite well. The only negative observation here is 08, and I've already tried to argue that this doesn't feel like 08, and I would say 08 really was not an inflation problem. It was an over leverage problem. Now, I've been showing this slide for a year, hoping, it was the right advice for investors, believing it was the right advice for investors. If you look at the averages, plus 17% 1 year, plus 28 2 year, plus 46 3 year, and you can't guarantee those types of returns. But how has the market done since June 2022? On a price return basis, it's up 17%. You can't make this up. The 1 year is right in line with the average. Now, that's just a coincidence, but again, it's a reminder of how markets tend to work. When there's a problem in the market, in this case, inflation, investors tend to focus on whether it's good or bad. And for the last 12 months, inflation hasn't been good, but you can't argue that it hasn't gotten better. And that's how markets trade. And that's precisely what's happening. Now, what's going to get better over the next year or two? Well, the Fed will be done tightening. The economy will have rolled over. In my opinion, the recession won't be as bad as people think, and you'll start to see the economy improve. And so if you believe in that story, which I wholeheartedly do, then you believe that the markets will do well over the next couple of years. Now, in terms of positioning, and I'll pause after this chart, the market's been bouncing through these different economic regimes. And, we talked about how in a cycle, you go through recovery, expansion, slowdown, contraction. A lot of that has been driven by the Federal Reserve. And so all that tightening has had us in that right column more recently, which is a contraction. We talked about growth being low. Our leading indicators had come down. Usually the Fed's easing by that. Still not the case because of the rate hikes. And so you'd been in that contraction. Government bonds tend to do well. And of course, we saw bonds yields come down pretty significantly. Quality bonds tend to do well. In equities, you can do okay, but you really want to focus more on higher quality, defensive, lower volatility names. And that's why those big mega cap tech stocks have been the winners. Now, the market's telling you a little bit of a recovery here. A little bit of recovery here. I showed you the financial conditions starting to hook up. In the recovery, that's when you want to take on a little bit more risk. But I think you're going to be bouncing a little bit here between recovery and contraction over the next handful of months. So it's not going to be a straight line. It's a roadmap, but ultimately where we're heading is the left column, and the left column moving into ultimately that expansion, like that beginning of the new cycle that tends to happen when the Fed's done tightening. And that's an environment that becomes more friendly for risk taking. You want to be exposed to equities. You want to be more cyclical, value oriented, smaller cap, non-US dollar types of things. And you want to be exposed to riskier credit. So right now, a lot of people enjoying cash, the short-term rates that they can get in cash, but in a recovery and expansion, you tend to do well in higher yielding instruments. So, the bottom line is we're still working through a policy tightening environment. We're getting closer to the end. As you're still working through it, you could see some volatility, but the end of the tightening sets the stage for the new cycle, which sets the stage for a nice environment, in our opinion, for risk taking. So, a little bit of realism there, but certainly a 1 to 2, 3 year optimistic look on where we're heading. So I will just show my footnotes, my disclaimers, and we'll thank everyone. And I will turn it back over to our hosts.
Thanks, Brian. I really appreciate all your comments today. We talk with our clients about providing clarity, comfort, and confidence to them, and through building financial plans and all the pieces that go around them. But I think there's also clarity and comfort and confidence that comes from having a roadmap of where we're going in the markets, right? So we appreciate you taking the time to lay it out today. Thank you so much. If you have questions for Brian or for us at any time, of course, please reach out to any of us on the team. Thanks and have a great day.